If an individual at 30 years starting or investment of about 30,000 rupees in a good mutual fund, expecting a decent return of about 12%, at the age of 50, he or she should have at least 3 crores in their kitty.
As an investor, my goal is to make 1 crore rupees. Now, if I have 20 years, the monthly SIP that I need to do is about 10,000 rupees. Let's say at a 12% rate of return, it's about 10,000 rupees. On the other hand, if I have only 10 years, I want to make it in 10 years, my monthly SIP has to be 40,000.
In the income tax, whether it's regulated or unregulated, income is taxed. So it doesn't matter whether you got a legal income or illegal income. It becomes an income and you're supposed to pay tax.
I'm excited to jump into today's discussion on a topic that resonates with so many of us, which is how much wealth can you build as a salaried individual? So to begin with, sir, how is wealth building different for a salaried individual compared to an entrepreneur?
See, salaried people get money on a regular basis in the first week, whether first or second or third. So they have predictable cash flow in their hands. On the other hand, the business people or entrepreneurs whom you are referring to, their cash flow is not that predictable. They get big lump sum sometimes they have a dry run. So to that extent, both are definitely different.
So, have someone having been an entrepreneur and as a salaried employee, I think the way you think is totally different. When you're an entrepreneur, your wealth creation is happening because of your business, right? So you have a lot of risk. It might be 100 crore business. It might be you might be struggling for expenses, but that's your main way of wealth creation. As a salaried employee, you're only making so much money every month. So actually, making that money work for you is your way to grow your wealth and become rich.
Understood. Mepin, what would you say are some common financial aspirations of people earning a 1 lakh monthly salary?
Typically, what I have seen is the first financial aspiration for salaried employees is a car at the younger stage. And probably it moves up next to the house. They also today have aspirations of traveling around the world, which is a upcoming or a fast growing aspiration. And the last one, maybe towards the later stage, towards child education, where they want to ensure that their children study in a good school and or a college, and then move up in their career.
So, Kritika, what percentage of like a 1 lakh salary should you ideally be saving, considering today's expense levels in India?
Okay, so I would think of it this way. So when your salary hits your bank account, you have some monthly expenses that you have to bear, which is like your food, your rent or your EMI, etc., which are essential. You also have some annual expenses. So for example, you may have a school fees of your child, right, which you have to this. These are all your essential expenses. Typically, when you look at it, your essential expenses are somewhere between 50 to 60% of your income at the most. Sometimes it's a little lower, sometimes it's a little higher. It depends on your age. So if you are just started earning, you don't have a family to support, it might be a lot less. If you have a family to support, for instance, it could be a lot more. Then of the, let's say, the remaining 50%, there are two categories. One is your discretionary expense. You want to have a treat out. You want to make a vacation plan, right? So typically about 10 to 15% discretionary expense, depending on, person to person basis, can be advised, which means that at the least about 30 to 35% of your money should be going into savings. Now, here's the interesting thing. If you are younger, don't have that many responsibilities, you should be investing a lot more because you have more time to compound that money and make it work for you. So you might go as much as 45% of your income. Whereas if you're in a later stage in your life where you have lots of responsibilities, maybe you have your children, you have your parents, etc., you may be only able to do 20 to 25%. But at no way, I would say a benchmark that investors should look at, it should be less than 20% of your income.
But only one point I want to add, whether it is 20% or 25% or 30%, it doesn't matter. But the product what you are selecting to invest becomes all the more important than saving money. Now saving is important. Now if you're going to allow the money to lie down in a SB account, you will not get the desired return. But if I'm going to invest 20% of my income regularly in my equity funds, then the results are far more higher there. For example, I always used to say the consistency with which you do things are much more important than doing things on a random way. If an individual at 30 years starting as or investment of about 30,000 rupees in a good mutual fund, expecting a decent return of about 12%, at the age of 50, he or she should have at least 3 crores in their kitty, which is phenomenal in my opinion. I am not talking big things. We are talking about lakh of rupees salary. And the salary is not going to be stagnant. It is going to increase from time to time, and you will change your job and your income will go up. But at least this 30,000 rupees, what you start now, continuously maintain that at the same amount in an equity allocation, you're going to get sure of 3 crores, which is far higher than your provident fund or gratuity when you retire. So that's how one should build a corpus, and then you can build on that later on.
So, apart from mutual funds, are there any other investment options available for long term wealth creation?
See, I always say there are only four methods by which you can invest your money. One is your fixed income, that is your fixed deposits, which everybody knows. Going to a bank and deploying the money in a fixed deposit or post office deposit. For a senior citizen, he always goes and deposit, or a company deposit. That's called fixed income group, giving you about 7% return, which is just not enough even to beat the inflation if you adjust the taxation. The second part is investing in the gold, which is very, very popular. Whether it is a physical gold or a paper gold, one has to decide that. But the gold investment in India is far higher. The third portion is real estate. People buy land, building, apartments, flats, and whatnot. That is another one. The last category of investment is equity component. Now, equity has got direct equity and also mutual fund investing in equity. These are the only four categories you can invest, whether you are in Bangalore or Chennai or London or New York. These are the four options you have available. So, one of them it has to match. But I can tell you that equity component can outbeat any of the asset classes if you are having long term view.
Ritika, so, how should one invest in these investment options?
Okay. So, just taking on from what Mr. Narayan said, what is the goal of an investor, right? You're earning 1 lakh rupees, you want to build wealth. Your goal is two things. One, you want to beat inflation, right? Inflation is your enemy, which makes things more expensive year after year. You want to make sure that your money is growing at more than inflation. So you're increasing the value of the money that you have. Second is you want to keep it as long as possible. Now, let me explain this with a simple example, right? So, suppose as an investor, my goal is to make 1 crore rupees. Now, if I have 20 years, the monthly SIP that I need to do is about 10,000 rupees. Let's say at a 12% rate of return, it's about 10,000 rupees. On the other hand, if I have only 10 years, I want to make it in 10 years, my monthly SIP has to be 40,000, almost 4 times. So, the longer you put your money in and you keep it invested, the more it works for you and the better is the compounding. That is the secret actually for a salaried person to create wealth and to become rich, right? So I would say these are the important things to keep in mind. People get very confused by a lot of products. So you hear about crypto, you hear about futures, options. I think getting invested into mutual funds. Mutual funds is a fantastic product because it balances that risk return for the retail investor, and keeping it invested for the long term is the most important thing.
Mepan, what would you say are like any major risks associated with the investment options that AKN said?
So, as Narayan sir said, for fixed instruments, fixed income instruments, which is like fixed deposits or let's say post office schemes, whatever, right? So, the major risk is obviously inflation, right? You are not on a post tax basis, you're not going to beat inflation. Well, you might have a steady rate of income. So, it's not really going to be enough for you to create that wealth for your retirement. The risk on real estate is obviously because you lot of money in one asset, concentration, there is illiquidity, you can't exit at any point of time in a quick way, and with reference to gold and equity, volatility is a big risk. So these are the risks that I look at from these instruments.
So, are the products you suggested regulated or unregulated, and does it even matter to begin with?
It is very important for you to know where and which product you are investing. If I'm going to invest in a product which is regulated, at least if there is any problem, I can go and complain to the regulator. Now, people don't understand majority of them if they are not attending to the awareness programs or not reading in the newspapers between the regulated product and unregulated product. Why I'm saying so? Many of them think the chit funds are highly regulated. Yes, few good companies are there in India which are in existence for very very long time and regulated by Ministry of Corporate Affairs. Now, in my own road, somebody starts a chit fund and I put some money there because I know him. So I give him money every month on month. After 20 months, he is expected to give back my money. Now, if he escapes or if he abscond himself, what will I do with him? Can I go to SEBI or IRDA? I cannot go. So because it is not a regulated product. So where can I go? I can only go to the nearest police station and complain about this gentleman. When you're talking unregulated products, one good thing is now happening now in India is about crypto. Now cryptocurrency doesn't figure in the top four whatever I gave you. Crypto is an unregulated product, no regulator for that. But then do you know 10 crores of people are investing in crypto in India as compared to 6 crores of people investing in mutual funds? Why? Because they think they can make more money. Across the globe it is running and there is no paper, and it is all by using computer website passwords and all that. And recently we heard one episode where one intermediary disappeared from the scene altogether, putting all the subscribers into trouble. The first and foremost, you have to invest only in a regulated product, and without understanding the regulation or regulator, don't go anywhere else. Because just because income tax charges 30% on crypto gains, it doesn't mean it is regulated. Because income tax people are capturing the data, and I think they are charging 30%, especially if you are investing in crypto, you have to declare separately like a global assets. I don't know, Mayappan may be able to tell you that better.
That's correct, sir. I mean, in the income tax, whether it's regulated or unregulated, income is taxed. So it doesn't matter whether you got a legal income or illegal income. It becomes an income and you're supposed to pay tax.
Mayappan, you had mentioned volatility being one of the major risks associated with investing in these products. So, how should an investor deal with market volatility?
See, good question. So, the way you would have to approach is in especially equities, right, or a gold, whatever. So, the longer the duration you hold on to the investment, the lesser the volatility. So there is some analysis which was done by a research team which says that beyond 5 years, over the last, if you look at the last 20-year data that we have in Indian equity markets, beyond 5 years, the probability of you having a negative return and loss of capital is less than 5% and goes below 1% once you cross 7 years. So time is your friend in volatility, right? So so you have to wait patiently, stay put into the product. The other thing is that we always think about volatility in prices, but I would like to bring about the fact that there is volatility in your mind. So you have to make sure that your mind is not volatile, irrespective of whether the price is volatile or not. The third thing, if I have to look from a solution perspective, is keep the money that you need for the near term requirements in emergency funds, right? So you put it in a liquid product, ensure that you have the money for the next 3 years, 4 years, whatever. In a highly liquid product, it might earn less return, but at the end of the day, that's the cost for it because you're expecting safety. But anything that you don't need for more than, let's say, 5 years or 10 years, that's the money that you can actually take risk on and then make volatility as your friend and then compound your money for your wealth. The other thing is that in terms of volatilities, you have to, how do you manage volatility? You have to buy good quality investments. Buying quality will help you sleep peacefully. So that is something that's also critical. For a person who's salaried, Investing through SIP mode also ensures that you buy in the ups and in the downs of the market across the market cycle, and therefore you ensure that you average out your prices on both the ups and downs, and that can also help you avoid volatility. So the thing is that you should not follow necessarily the herd behavior always. I think volatility is your friend is the way I look at it, provided you are patient in investing.
So, just want to illustrate something that Mayappan talked in terms of how you think about managing volatility. So, let's say you have a goal which is 10 years away. Let's say you want to send your child abroad or you want to retire or something for which you're saving money. Initially, you want your money to work hard. So, for the first 5 years, you're really not bothered about the ups and downs. So, I'm just giving an indication. But let's say first 5, 6 years, you're not really bothered about the ups, downs in the market. You just want it to grow. So you will put it into the market and you will just let it be. You will continue to invest in the market. Let's say after 6 years, now you've done a lot of effort, you've already built some, you don't want to lose this. That's when you will take some of it out and you will put it in, say, more safer products and keep some in the market for growth. As you come closer and closer to the goal, you will put more and more into safer products and keep less in the market. This is a good way for a retail investor to manage volatility on any goal that they're looking at.
I want to add, they have explained to you the volatility. I'll tell you in simple terms what is volatility for a common man to understand. We all have gone to trade fair and we have gone in the roller coaster.
Yeah.
Now, roller coaster man buy the ticket and he makes you sit in the seat and he gives you some instruction. He asks you to wear a belt and tell you to hold the handle and keep quiet. Now, the ride may be 2 minutes or 3 minutes. You have bought a ticket for roller coaster ride. Now, when it goes up and down, you feel very much worried because you may fall down or anything. But remember, he has told you to keep the handle very close and don't take any action from your end unless he stops it. Same way is the capital market functions. There will be roller coaster rides. You have to remember, if you're going to open the handle when it is in the top, what will happen to you? You will only get hurt. Same thing is happening to the investor today in the market. When the market goes down, they think they should jump out of the sinking ship. It is not sinking ship. It will come back to the thing. So the same thing happens in share market. Unfortunately, people tend to ask the same question whether the market will go up or come down, whether I will lose my capital. Same thing is happening again and again. This only experience will tell them that they have to handhold with a good advisor and wait till they reach the goal.
Speaking of goals, assuming you're a 30-year-old individual making a 1 lakh monthly salary, realistically, how much wealth can you expect to build by the time you turn 50?
Let's say I have 30 years, I'm investing 30,000 rupees a month, right? And I'm getting about 12% rate of return, right? In about 20 years, that money will become about 3 crores. I think Sir talked about that, right? That is a significant amount of growth in your wealth. So, for example, if you put the same money in an FD, which will give you about 7%, the amount of wealth you will accumulate at the end of 20 years will be maybe 1.4 to 1.5 crores. By putting it in mutual funds, you'll actually double the amount almost of what you make.
See, basically, what we are trying to tell is your resources are limited. I have limited amount, so I must optimize my return by putting it in a suitable product so that my goal is achieved and my wealth is creation also happens. Same thing happens. I've been telling that even in a PPF, it's a great product, public provident fund product, which gives you 7%, 7.3 product percent of the return, which is tax free also. But then 15-year lock-in period, you're ready to wait. 1 lakh, can become 30 lakhs at the end of 18th year. But same thing if you're going to do it in a fund which is giving you similar tax exemptions, can give you 1 crore wealth. So you are able to give 3 times your wealth creation by just switching from one product to another product, knowingly that this product is going to create wealth for you. So PPF was the ELSS is a great example for wealth creation with limited money. I'm not talking of big money. I'm talking of 1 lakh per year as an investment for 15 years, and you are creating wealth of 1 crore at the end of 18th year or 19th year. So the objective being to create wealth, you must have a strong conviction in Indian market. The last 25 years, how the growth has happened. Today we are talking of 4 trillion economy. In another 20 years, will it go back to 1 crore, or it will go to 20 crore economy, trillion economy? That is what you should look at. The next 20-25 year is going to be a great growth story in India. Whatever wealth you have created in the last 25 years, it will be much higher for a person who is going to invest from now onwards. You are in the right time, right place, right product, and only thing, your mind should be all right to look at selecting a good product and invest money in that product and look at long term. And if you're going to look at long term, and if you are very patient enough, then automatically your wealth is created.